Okay, very good morning, Friday the 15th of June. Hope everyone is well, had a good evening. Just kind of overlooking some of the news firstly from overnight and just looking at the ECB and the Fed really from this week. And reading some of the press this morning, I have to say I absolutely agree. I think Jerome Powell, especially Draghi yesterday, have managed to pull it off. An exceptional job. Unfortunately, if you're an intraday trader, you kind of wish that these guys don't do such a good job. But yesterday, certainly, even though he's managed to tighten monetary policy, did create a phenomenally large move in the markets. Trying to get hold of it, quite difficult on the first half of the event, but certainly the press conference, we continue to see a sell-off in the euro, and consequently it supported the DAX. So wanted to have a quick look at really why I think he's managed this well from a broader perspective. Then we'll look at the kind of nuances of what exactly happened. Is because if you think of where we were in February of this year, the market went into a very short-term phase of correction in the equity space. That was after we had touched record highs, because the main thinking was that people were panicking about the speed of monetary policy tightening, getting to a phase of multiple US rate hikes. You had people like at the time, you had people like the ECB, the Bank of England, and even the BOJ talking about making some more kind of less dovish, moving to a more hawkish type communication strategy, and that spooked the markets. But fast forward to today, only a few months later, and you've had the Fed hike interest rates. Now, the 7th time. You've had them move the number of hikes up one notch to 4 from 3, so one more as well than they did last year. And then you've had the ECB come out and effectively outline now the end of their QE program. And yet, the world hasn't ended. The euro's not shot through the roof, and equities haven't plummeted, albeit just seeing a little bit of S&P weakness. But look, this is a couple of ticks here. We're not talking about the type of move that we saw in February. So they've managed to effectively communicate in a way to keep the markets in relatively calm, stable fashion, but are continuing with this normalization process. So looking at the ECB firstly, obviously for those who weren't in yesterday or aren't crystal clear on exactly what happened, it was the first port of call was the identification about the end date and how they were going to execute that from the current purchase size of 30 billion. And so what they did was they inserted this additional phrase talking about the monthly pace of net asset purchases will be reduced to 15 billion euros until the end of December 2018, when the net purchases will then end. So if you remember yesterday, we had that initial very brief blip higher, because actually when you look at the Bloomberg terminal on the first headline run, that is the key headline. So people jumping on that quick, but then it was the additional language to kind of soften the blow, if you like. And the main one that most people are looking at is the kind of third point of which comes in the center of their statement, and it's about interest rates. If you look at the short-term interest rate futures, we were pricing a interest rate hike from the ECB in around June-ish time of 2019. So this being the end of QE, the hike then coming a few months after. But what their language would come to suggest is that really you're looking at more of a potential autumn time interest rate rise. And so what he's kind of done here is that he's kind of given with one hand or taken with one hand and then given with another, in that yes, we're going to end QE, but it is going to be extended. It is going to just drop to 15. There were some banks looking at slightly more aggressive, smaller size purchases, which would have been more hawkish, but then saying we're going to have an extended period of when rates could then remain as they are. That also the reinvesting of principal payments, that you would expect to remain in place, but I guess that just adds another degree of continuity to QE remaining in the system, and obviously it had a monster move lower in the euro. I, for one, was very surprised by about how sustainable that move was. And actually I did see a good tweet this morning. Let me see if I can bring it up, because to put it in context, the size of that move here, this is the euro dollar daily change, and you've got to go all the way back to Q2 of 2016 for the last time we saw such a large one-day move in the euro dollar pair. So sticking on a 90-minute to get a bit more of a sense of where we have been to where we are at the moment, this was it. So you had that Italian political crisis, almost seems like that's done and dusted, albeit it isn't. It's just moved off out of the spotlight. I'm sure it will re-emerge at some point, but with the ECB coming in focus, I mean, just have a look at that one-day performance in context of the moves we had been seeing. You know, you thought Italian politics was, you know, the beginning of a new period of potential volatility and renewed heavy downside in the euro. Well, that took, you know, a move that was a bit more gradual. Yesterday's was really quite violent, and then as we broke some key levels, you know, the first kind of target was on the initial break of the week of that weekly range, was down in that kind of consolidation phase of late May, June, broke that, quickly broke then the levels below, and you can see how that was then timings wise, we were kind of at the latter part, if not concluding up the press conference, and you know, certainly for me, this is where, you know, I got a bit caught thinking, well, this could be the bottom end of this move now, because that's a, you know, you're looking at a move of, from its extremity to its low, you know, it's almost a 2-point move, and then down it goes again, punched low on the break of that before it kind of stabilized. And you know, looking now to the actual Italian lows that we had, if I can call it that, in the euro, it's probably the next key area if we were to remain heavy. But one thing I would say today is just reset, press the reset button in your mind if you can do that. What happened yesterday was the biggest, what I've just said, yesterday's euro move was the biggest one-day move we've had since the second quarter of 2016, right? So if we were going to take that as a statistic and roll it forward, you know, I'll see you guys again for the same type of price action in 2020. What I'm saying is, don't come in gung-ho this morning thinking, well, right, yeah, I'm just going to hit and sell the euro because we're just going to get an exact repeat. It's really dovish. I now get it. Let's just hit it again. Because that may happen. But what I'd say is you've got to just reassess things. You know, the market's moved a long way in a very short period of time. So, you know, just looking at where we are at the moment in the euro dollar, we've just come back up to retest that kind of initial late Asia Pac European entrance high. And if you were looking to play any type of pullback, then just be looking at the relative key points of interest now and marking up your charts accordingly to how the movement kind of trickled down lower yesterday. You can see there on that 1671 when we kind of broke. We initially had support, broke lower, came back to test before then dipping lower again. You know, the other points in between there, you've got the initial highs that were seen. So these are points of where, if you were looking at that strategy, you can identify as areas to then come out of some of that trade to manage it accordingly, or looking to play it and then positioning of your stop loss and so on and so forth. So I think you just got to get back into the swing of things that, you know, are we going to pull back all the way to 118? I would say that's a big call, and I would say unlikely to do so. Not unless something, you know, spectacular was to come out and Draghi says, you know what, I got it all wrong. On that side of things, I'm not sure if you guys were here last night or caught it in time, but guess what came out last night? If you've had a dovish ECB press conference, what do you think comes out that evening? Hawkish ECB sources, of course. This is absolutely ECB 101. If the market they see has had a really big reaction in a dovish or hawkish way, it's very often the kind of covert way of which the ECB just likes to go, whoa, 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 just steady on market. You know, don't get too carried away here. And there's some ECB sources that came out last night. This was around 6 p.m. and they said policymakers split over the wording of stimulus end and a rate hike. You know, that rate hike comment, which, you know, took a lot of the movement yesterday. Others wanted to signal that interest rates could rise as soon as mid-2019, rather than the accepted formulation, which implies a move in the autumn, the sources said. So there was a little bit of disagreement where they weren't so committed to being so lenient on the timing of the interest rate rise. This was the article that came out on Reuters last night. So, you know, that you could argue then, I'm not saying it totally reverses what was said yesterday, but if you were looking for a rerun and a retest of the lows and another push lower in the euro, well, this might be a little bit of a hamper to that view, because it's kind of suggesting that, you know, those dovish expectations, the aim of this, indirectly from the ECB for sure, is probably to just stop an all-out assault on the euro at that point. So might help at least some of the recovery for the moment. That being said, if the euro does start to recover anyway meaningfully, then you remember the correlation was quite good yesterday, and when we broke some key technical levels, actually what I thought was the easier trade at the time. Sorry, there's a bit of coffee noise in the background. I must be putting one of the guys to sleep. I'll try and spice it up. But one of the things was that the DAX was moving in a really nice step, with key technical levels were testing. Remember yesterday in the futures, 13,000 was there, and as the euro just broke that key level we were looking at during the course of the meeting, it was a real nice trigger point for another pop higher in the DAX. But like I said, if the euro starts to recover today, then I'd just be mindful of potential also a little bit of a pullback in the DAX. If that were the case, again, just identifying some of the ranges. So maybe this platform that you've had from the late Eurex session last night to where we've also had some support early morning. Any breach of that could then look for the eventual pullback back down to the pivot level. Yeah, so you're just looking here on a daily continuation. Just excuse some of the markups there on the chart, but got up to a really key test in the DAX, real big level, kind of hit that and got rejected. And so maybe a little bit of a pullback could be understandable, just given that situation of the key hold that we had from yesterday's session, and if the euro starts to reverse. Looking elsewhere though, US futures, a little bit of pressure this morning. There's not a great deal of new news. Obviously there's been a bit of focus on China yesterday about the slowdown of their economy. This morning the story that people certainly are looking at is really, it goes back on the state side to a focus on trade wars. Now the central banking job is done, at least for the time being. This is the main kind of headline being run on the news wires. Trump approving tariffs on 50 billion of Chinese goods. The final product list due today. China has vowed to retaliate in kind, threatening a trade war. Now this is the big risk, is that latter point, I feel, is that so far China has been, you know, fairly receptive to what the US have been doing and offered various concessions. I don't know if you saw ZTE shares coming back in this morning. I think they lost another couple $1 billion off their market cap after they paid out on that fine. But this probably is what's helping some of that relative risk off just creep in some of these other assets. You've got a little bit of weakness in US equity futures. The US 10 years just picking up. Dollar yen's just tracking back down to Asia Pac lows within sight of pivot. So trade wars, now the central bank kind of show is over, could well be one of the themes, I'd say, to monitor for the rest of the session. S&P, you're coming down to the S1. So obviously you've got the intraday low that we're seeing yesterday as a line of key technical support to have a look at. And then beyond there, maybe that S2 lining up with the low that we printed on the 7th could be something interesting also to monitor. Let's have a look at the Dow. Where do we sit on here? Yeah, so a lot of these futures markets, don't forget, looks like we've had a contract roll, hence the light candlestick print on the charts. So we're trading the SEP front months futures now. So yeah, what I would do, and my suggestion as always, is to just go back, start identifying then how you would play this accordingly, given that it's got a bit of a negative setup from the news perspective. Okay, fine, identify then some key levels on the downside here, because if you've got equity, let's take this trade as the main story of the day. If the US ratchet it up, China say they'll retaliate. This goes back to a classic risk off. So what you're seeing now is dollar softening slightly, which tends to be the way this goes on heightened trade war fears. That helps elevate gold. The weaker dollar then will help support the major pairs, which also might play into the hands of that euro with a bit of recovery today. And we've just seen cable reclaim the 133 handle. So I do think that that's probably going to be the main key news item of the day. Just quickly, I'm not going to dwell on Brexit too much because I think the move yesterday is, yes, there's some continued political uncertainty ongoing emanating from this whole, what are they going to do with the customs union and Parliament's say on the final deal and so on. But I'd say the move yesterday was more kind of in sync, cable under a bit of pressure with the kind of overall dollar strength initiated by that supreme weakness of the euro. Also as well, the retail sales data in the UK, forget it. We discussed this yesterday, really hot weather in May, a royal wedding. I would have it a guess that June's retail sale figure for the UK is also going to be equally quite strong, just given the World Cup. And so no one really is looking at that data for any longevity of a strategy because, as you can see, it's kind of brushed aside completely. But with the Brexit side of things, where we stand at the moment is that Theresa May faces a showdown with rebels over a no-deal Brexit. So it's by no means over for her and her troubles at the moment. So Dominic Grieve has said an amendment tabled by Mrs May on Thursday, and it actually came right at the deadline to be heard in the Commons for next week, he said was unacceptable and accused her of going back on a deal that rebels thought they had agreed. He said Mrs May's peace offering to the pro-European Conservatives drawn up after days of negotiation cannot be accepted. And of course this then leads to belief that it's still very fragile and she could face still or be vulnerable to a possible defeat when the flagship EU withdrawal bill does return to the Commons next week. The rebels, what do they want? Well, they want Parliament to have the right to block a no-deal exit, including asking for an extension of a 2-year Article 50 exit process. So again, just to be clear, this is where we're at the moment. We've talked about transitions. Now the talk of the rebels is that they want an extension of Article 50, which, because this legally has never been done before, there is no precedent, and actually, lo and behold, such goes negotiation strategies. What do Europe do this morning, given what the rebels are saying? They go, well, how about we have a chat about an option of an Article 50 extension, just to make life even more difficult, to leverage it against the existing government stance. This is kind of all political at this point. So Europe kind of very timely offering this little olive branch of an extension, which obviously just makes things all the more difficult for Theresa May because it will play into the hands of the rebel contingency. So yeah, much to play for. More press coverage, I'm sure, coming over the weekend. Moving on, with all the talk of the Fed and the ECB this week, you might have forgot you actually had a Bank of Japan interest rate decision overnight. The only thing is, not many people really are taking much notice because the Bank of Japan, as very much expected, keeps things steady. They offered a weaker view on inflation, so they're not getting anywhere near the point of signalling any move in policy, certainly on and any form of tightening like what we're seeing with other central banks. So not going to say any more on the matter than that. I'd say yen movement this morning is going to be more derived from risk than anything to do with the central bank decision. And finally, I just wanted to show this chart. You obviously had Saudi versus Russia kicking off the World Cup last night, and you had them have an agreement about doing, if you remember, 22nd of June is the OPEC meeting, 23rd of June, is then Saudi and Russia meeting. So it's the OPEC, non-OPEC meeting. I should say OPEC and non-OPEC, not Russia and Saudi, because there are other nations, but you know how this balance of power lies with those who are the most influential. The interesting thing here was that the blue line is the Saudi daily crude output, the white line is the Russian. And even though they've both agreed, and what kind of was quite interesting yesterday is they were talking now about a 1.5 million supply increase. Before, that number was at 1 million, remember. It was reported by CNN last week that the US were requesting 1. That's also what the Saudis had hinted. That figure's now gone to 1.5. And yet here we are. Oil did move a little yesterday, but hasn't sold off continuous on the back of that. So that's kind of the latest expectation. But what's interesting here is when Saudi and Russia are talking, you can really see how Saudi are so under pressure. Don't forget, Saudi are trying to deliver this game-changing 2030 vision, which is going to require a renewed higher level of government spending. And how is that going to be funded? Well, I need oil a little bit higher because my break-even fiscally has increased because of my objective over the next near-term horizon that I want to diversify my economy. For Russia, maybe not so much the case. And you can see that reflected in their output. Saudi really does go to its every means to try and cultivate an influence on the price of oil, whereas Russia, yeah, will play ball, but just been trickling along, and actually it doesn't deviate that much. So for me, this kind of says a lot about who has the power at the moment. And certainly you could overlay the US on this, and we saw that data this morning or earlier this week. They're now pumping up at 10.9 as well. So you've got Russia pumping 10.97, the US pumping 10.9, 10.95, and the Saudis are just about at 10. So they are distinct third place in the runnings at the moment. So quite interesting. I'm sure there are more intricate dynamics like the ability of the technology infrastructure for Saudi to be more responsive and things like that. But I thought just an overall summary point to make with these discussions coming up with that meeting. All right, look at the calendar for the period ahead. And you've got Eurozone CPI coming out at 10, but this is the final reading. So it's unlikely to be market moving. Then you've got the US afternoon, New York Fed manufacturing, US industrial production, and US University of Michigan sentiment. This is the preliminary report, so it is the more market moving of the two that come out. It's for the month of June, but this is what Michigan headline looks like. The last reading was in fact the lowest reading in 4 months, but do put into context where we are in the grander scheme of things, hence the reason why Jerome Powell and his Federal Reserve colleagues felt confident enough that they could speed up the tightening phase, because even though this data point had been a 4-month low, respectively it's still tracking at a very high level. And so I don't think any of this data actually is going to be that meaningful today to market price. Actually what I think will be is the trade war topic. That's what I think is going to be key now, and especially going into the weekend, looking out for particularly any more detail on a Chinese response. How positive or negative they might be could define then the sentiment for the rest of the session. Okay guys, going to leave it at that, let you guys get on. So have a good day and a good weekend if I don't talk to you before then. Thanks very much.